Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, and other investment leaders who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out our website at dakota.com. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am thrilled to introduce our audience today to Amanda Kane from Windrose Advisors. Amanda, welcome to Philadelphia.
Thanks for having me, Rob.
Yeah, thank you for being here. And we're also joined today by Andrew O'Shea from Dakota. Andrew, welcome.
Thank you.
Thank you for being here. Yeah. I know it's a busy time of the year. You're surviving?
I am surviving. It's gone by fast this fall, but always exciting around the holidays and looking forward to 2025.
Well, we have a lot of questions to ask you, Amanda, but before we do, I'm going to introduce your background as well as reintroduce Windrose Advisors. Windrose Advisors, a boutique advisory firm setting the new standard in modern wealth management. The firm delivers unbiased, highly qualified financial advice to families, foundations, and endowments. The result is a close, trusted relationship and endowment quality investment platform that preserves and grows wealth. Their client-centric approach emphasizes accountability and a seamless client experience, ensuring that every individual receives dedicated and customized financial guidance. With over 15 years of operations and with a combined experience of investing over $100 billion for families, endowments, and foundations, the Windrose team focuses on establishing trust and mutual respect with each client to ensure a shared vision for preserving and growing wealth. Amanda Kane is a director at Windrose Advisors, where she focuses on asset allocation, manager selection, investment due diligence, and designing investment portfolios for clients. She began her career as an associate at a boutique strategy consulting firm, then joined Windrose Advisors for over 2.5 years as an associate. She later honed her expertise in private equity manager due diligence as a senior research analyst at NEPC for a little over 2 years. Amanda returned to Windrose Advisors first as a vice president and now as a director. She holds a degree in economics and Spanish from Merrimack College and is a chartered alternative investment analyst. Most importantly, she calls the greater Boston area home, where she lives with her husband, son, and 2 dogs. Amanda, thank you for being here today.
Thanks for having me, Rob.
It's really a pleasure. We were talking before we started recording that this is really a unique opportunity for us and for our audience. We get to often interview representatives, usually 1, maybe 2 from an organization. But with Windrose, we have had a chance to meet with Gilda Kinkis, the Chief Investment Officer, Salisha Zhao, the Deputy Chief Investment Officer responsible for public markets, and now you, responsible for private markets. So it's really exciting for us to be able to fill out all 3 legs of that stool. So thank you for being here.
Absolutely.
Yeah, one of the challenges of from the asset manager side with multifamily offices or family offices is there's a lot of generalists that are involved. It's not always clear who's doing what. So it's always interesting to hear under the hood of a top multifamily office how their team is structured. Whereas, a larger institution that has a huge team, they have 1 person dedicated to venture, 1 person dedicated to buyout. So it's exciting to hear from all 3 members of the Windrose team.
Yeah, absolutely. Thank you. So we're going to get right into it. And one of the things that we're always interested in are the aspects of your background. So when you think about your career journey, how do you believe it uniquely positioned you for your role and responsibilities with Windrose Advisors?
Absolutely. So I think every step along the way of my career has really positioned me well for this role. Starting in strategy consulting, the role was really PE diligence. So those engagements really gave me exposure to the private equity world on the deal level. So got a really good understanding for the industry there from one side of things, and then sort of switched over to the asset allocator side, where I joined Windrose as a generalist investment analyst. So my time as a generalist was so valuable to my career. I do think, to Andrew's point on, the different models that firms have, I think for young professionals, starting as a generalist is the most valuable. It gives you a really holistic view for what we have to do as asset allocators on the program level. And also for the young professional, it just kind of gave me the experience and the opportunity to decide what I really wanted to do. So learned so much from Gilda and team supporting them across asset classes for, over 2.5 years, which led me to ultimately decide I did want to focus on private markets. And that's what led me to NEPC. So NEPC was, a great opportunity for me to really do a deep dive on the private markets. Worked with a great team there, met hundreds of managers, and really just got a really strong understanding of the private market space and built some really important connections, which I've brought back to me at Windrose, and has really helped me kind of build on the program that we have going here for the last 3 years.
That's great. So when you think back to those days at Merrimack College, you're in an econ class. Did you ever think that you'd be working in manager research and due diligence?
I did not. I have to say, I definitely didn't. This was not a world that really occurred to me. But I would say that I actually did an internship at a private equity firm while I was still at Merrimack. So that was how I kind of tiptoed into the world and what led to the beginning of my journey. And it was kind of all history from there.
So how have your responsibilities changed over time? When you think about your career evolution with Windrose, you were there for 2.5 years. As you just said, you went to NEPC, now coming back, and you've obviously had success as a director now. So when you contextualize that with some of the challenges and opportunities that have emerged, particularly in the multifamily outsourced CIO space, we'd love to hear kind of how things have evolved for you.
Yeah, so from my seat, I've really evolved, I think, from an individual contributor. I started out, really just supporting on diligence engagements sort of across all asset classes, working and learning from more senior members of the team, which was, the best way to get started in my view. And over time, I've really evolved to leading those diligence engagements, as well as managing the portfolio management side of things on privates, as well as managing our relationships, which is such an important part of the private markets and one of my favorite elements of the role.
So speaking of new challenges, we asked Salisha last time she was in Philadelphia how clients should adjust portfolios in light of the recent political shifts in the market. A question we hear a lot from allocators on the manager side as well. Just curious how you all are addressing that.
Yeah, absolutely. I know Gilda and Salisha have both been on the show, so I'm answering from the private market lens. And the answer is that we cannot time the markets, especially in privates, as I think you both know. These are very long dated commitments, and we need to maintain our vintage year diversification. And that is the ultimate goal in how we educate our clients to invest. And we think it's a really important part of maintaining a successful private markets program.
What's that education process like for your clients when you're explaining to them vintage year diversification and how that differentiates you in some ways relative to your peers? How do you approach that conversation?
Great. So I think those conversations are really centered around explaining why vintage year diversification is so important. Some vintages will absolutely be better than other vintages. We can't time the way those markets work. And so it's important to maintain that exposure and those relationships. And we believe we're partnering with managers who are poised to outperform regardless of where we are in the market cycle, which helps bring comfort to that discussion as well.
So we've talked a lot about U.S. philosophy on the importance of manager selection. Everyone does it a little differently. Could you just walk us through the process of your due diligence process once you've identified there's a theme or an exposure you need to identify through an active manager?
So absolutely, and manager selection is critical, as you both know. We spend a lot of time getting to know our managers. We love the opportunity to meet with them initially off cycle before they're really raising their next fund, and it gives us the chance to take our time, get to know each other because it is a partnership. So if we decide to engage with a manager and fully conduct diligence, it's a thorough, many month process, or we can move faster if we have to, but we like to take our time and go deep. And it involves spending time with as much of the team as possible, really understand how they think about their strategy, really understand the deals that they have in the ground, understanding downside protection, understanding upside, and really understanding how they perform across a market cycle. We need to see that managers have ability to outperform regardless of where they are in the market cycle. That being said, we need to be forward-looking and not backward-looking. So while all of those things are important, what we're really underwriting is what we think their potential is on a go-forward basis. So that means alignment is a huge part of the discussion and of the diligence. So we're really trying to understand, how are these managers incentivized and how are they motivated? Is the fee structure appropriate? Are they raising an appropriate amount of capital? And then other, key elements for us are understanding how they're driving value. So do they have a history that's repeatable in terms of creating value at the operational level versus, for example, relying on financial leverage?
Taking a step back, if you think about the sourcing process of, when you're identifying managers, one area that both Celicia and Gilda touched on was the importance of relationships. So when you're building out those relationships, what advice would you give to an asset manager, particularly in private markets, who's looking to, contact Windrose for the first time and build that relationship? What does that process look like from your perspective, in your current role?
Yeah, absolutely. And I know it can be challenging for groups that don't have a warm connection because LPs are constantly getting called on. We all get thousands of emails a day.
Exactly.
So I know it's an important question. And I would say being able to position yourself and really being able to highlight in a few short words what your differentiation is, finding a way to grab our attention, frankly, in absence of a warm intro. Unfortunately, warm intros and word of mouth are a big part of what we do from a networking perspective. We rely heavily on our networks because we have such deep experience across so many different organizations on the team level. So we do think that, that is where a lot of our ideas come from, but we don't want to be missing anything that's out there that, we haven't heard of through the grapevine or from, managers who are spinning out from firms that we know. We know there's an additional universe out there.
Another area that we talk about often with the guests on the show is this balance between the quantitative, the data, so making sure that the information makes sense in the data room, that you know what to find and where to look for it, all of the kind of the usual check the boxes. But there's this qualitative component, and that's kind of taking this whole relationship conversation a little bit further. And what are the qualitative characteristics that you think about when you do get that meeting? So let's say that warm intro, that relatively unknown, GP gets a meeting with you. What are some of the qualitative characteristics that you're looking for?
Yeah, it's a really good question. And I think it comes back to that point of we need to be forward-looking and underwrite the potential on a go-forward basis, which really is more qualitative than quantitative. We look at the track record, of course, and consider it, but we also just really need to understand how motivated this group is and what resources they have to outperform.
So what role do private markets then play in asset allocation models? So when we're thinking about this now from a top down, and I know we're taking a little bit of Gilda's thunder here,
This is.
but how do you approach these investments to enhance the client's portfolio?
Yeah, absolutely. So I'm sure Gilda gave an overview over our building blocks approach to asset allocation, but as a very quick recap, he's built a framework that helps position our portfolios to withstand sort of any market condition. So we have assets that will perform well in growth environments, assets that will protect in recessionary periods, as well as that will protect in inflationary periods. So we have private investment programs that cover, all of those areas. Private equity and private credit are generally considered growth assets, and they're, a big return enhancing part of most of our clients' asset allocation. That being said, many of our strategies also will benefit from a recessionary environment as well, as especially on the private credit side, where we have some more distressed players who can really lean in and take advantage of some of those opportunities. And then on the private natural resources side and private real estate side, both of those programs would fit into our inflation protection bucket as we think about our asset allocation framework.
I was going to ask you how you ensure a diversified mix across these asset classes, but it sounds like you're capturing it through these 3 or 4 verticals.
So you're exactly right, Rob. And we also ensure diversification within each of our sleeve programs as well. So on the private equity side, that really means we're making sure our program is well diversified in terms of strategy, sector, geography. We're making sure that every manager that we're adding to the platform is bringing something new and unique to the table. That said, in private markets, we think it's important for every manager to be, a needle mover in the program, and we don't want to be diversifying away our alpha or hindering outperformance by having too many managers on the platform. So it's a very delicate balance.
Amanda, private credit, obviously a very hot topic
Yes.
across the board. I know you all have historically emphasized more of an opportunistic approach, both capital appreciation, but also the resiliency in recessionary environments, which you just touched on. Can you elaborate how you all look at private credit and potentially allocate to that space, or what interests you now in the space?
Yeah, absolutely. So as you mentioned, we're definitely more capital appreciation oriented. We take a total return approach to our private credit, program. That being said, we do also consider, some more direct lending or income-oriented strategies, and that's really for a portfolio component. Those strategies are often, obviously kicking back income faster and offering some early DPI, which is helpful from a portfolio standpoint. But the bread and butter of what we're doing is, these groups that are more likely recycling capital during the investment period to maximize returns. And most of our managers have a flexible all-weather approach to what they're doing. Some of them can really lean in during distress periods and have history of doing so. So we think we have a nice balance of managers who can kind of perform sort of across the market cycle.
And do you incorporate real estate credit or other asset-based lending within your portfolios as well?
So we will actually, many of our private credit managers can have a somewhat of a broad mandate, and so some real estate private credit can be included in some of those funds on less of a dedicated basis, but they're definitely seeing opportunity there. And on an asset-based lending, it hasn't been as much of a focus, though we are considering some asset-based lending opportunities for 2025.
How do you think about co-investments when you think about how they fit into the overall private markets program? And there's an add-on to that. So how you're thinking about co-investments and whether you'll look at a co-investment from a manager who's not currently in the sleeve?
Very important question. So the answer to your second question is no. We will not look at a co-investment that is not brought to us by a manager that's on a platform. We think it's on our platform. We think it's a really important part of our co-investment strategy to keep it to a group that we've fully underwritten and fully trust. And so kind of for the first part of the question and how we think about co-investments as a part of our private markets, up to 20% of our private vehicles can be in co-investments. We are active co-investors, and we will invest only alongside our growth equity and buyout managers from a co-investment standpoint. So not taking on early stage risk on a single name in the co-investment. And we think that's most appropriate for our pretty concentrated mandate. And we really think that co-investments, and we've seen that co-investments have been additive to our return profile. First of all, it's blending down the fees, which is great. Most of these co-investments are on a no fee, no carry basis. And they're also really offering, I would say, a J-curve mitigation, if you will, because they have, we make a co-investment and it fully draws down immediately versus a fund that is taking 4 to 5 years to deploy. And typically we can expect a co-investment to exit much sooner than, the entire life of a fund to liquidate and wind down. So it's an opportunity for us to get some DPI back to our clients faster.
Great. That's helpful. And then in light of the markets today, looking out into 2025, where are you all focusing your time on private markets?
Absolutely. So, as I think I've made clear, we are not market timers, especially on the private side. So, what we're looking to do across the board, and private equity is no exception, is really be well positioned to perform, regardless of what happens. And on the private side, a big part of that is making sure we're partnering with groups who are clearly driving value through operational excellence and structural improvements, rather than relying on financial leverage. And this has always been the goal and has always been a focus of us. This higher rate environment for the last few years has made it clear that it's the right way to invest. But that's sort of how we think about, from an opportunity standpoint, it's not so timed.
Yep.
In addition to private credit, there's been a lot of conversations around venture capital, specifically early stage VC. Is that an area that you've been focused on?
Oh, yes. So we are very active in venture, and the venture that we have tends to skew very early stage. So that I would say that is probably an example of where we can be a little bit more tactical. We found in 2022, as the tech markets were experiencing some turmoil, there was a lot less fundraising going on in the space, and we actually leaned into venture a little bit more deeply, finding that there were exciting opportunities to partner with some capacity-constrained managers at the time, and at a time where valuations were finally looking like they were coming down to earth a bit.
Any thoughts between the generalist approach? So if you think about early stage VC versus the specialist, so that, that biotech fund or that frontier technology fund, do you have any preferences as you think about specialist versus generalist?
Yeah, so I would say we're opportunistic in that regard. Most of our managers do have specialized approach, especially on the early stage. That being said, we allow for, some flexibility. Some managers will be, very focused on frontier tech, but might find an opportunity that is a little bit, outside of the scope of their specific lane that, they think is exciting and that we can support them on. But in general, I think most of our managers are pretty focused, and that's what we want to see in the portfolio.
That's great. Thank you for sharing that. I do have a question. You're very generous giving our asset managers who listen into the podcast some advice about how to call, how to think about that warm introduction. How do you think about the balance between being persistent and being a pest? Because I think a lot of our salespeople who listen in kind of wrestle with that. They want to be persistent. They want to make sure they're staying in front of you, but at the same time, they don't want to be pestering you. So where do you see that kind of line in the sand?
So I know that it's complicated, and being a salesperson involves persistence. So that's hard. But I would say if you're getting feedback from someone that they're, it's likely not a fit for their program for one reason or another. At least I can speak for myself. I usually leave windows open if I think that there is an opportunity down the line. So I think if you're getting the feedback that it's a non-fit, then probably save your time.
Yeah, move on.
Yeah.
That's good advice. Thank you for sharing that. One question that we always ask our guests before we say goodbye are the mentors, the people who were helpful or influential in their careers. So when you think about where you are today with Windrose, who are some of those people that have been helpful for you?
Absolutely. I've been so lucky. I've had such a great suite of mentors, if you will. Certainly learning from Gilda. I mean, I felt when I started as an associate at Windrose so many years ago, I was just like a sponge listening to everything that Gilda had to say. And I learned so much from that time, and, really felt like I was well positioned to go in any direction that I wanted in the allocator world. Obviously chose this lane. So grateful to him, and grateful for him for the opportunity to come back to Windrose. Also very much, lean on my colleague Jennifer, who works with me on the private markets. She's an amazing mentor in the space who's been doing this for decades, has seen all the bad movies, and has really, taught me what to look for that I maybe haven't seen on my own yet, but I know what to look out for.
Amanda, thank you so much for all of your insights today. We greatly appreciate it. Thank you for visiting us here in our Philadelphia studios at Dakota. It was really a great opportunity for us to hear some more insights from Windrose, from you specifically within private markets. Also, congratulations on all your success at home and in the office.
Thanks, Rob.
Andrew, thank you so much for being here as well. It's always a pleasure.
Thanks. Great to be here.
If you want to learn more about Amanda and Windrose Advisors, please visit their website at www.windroseadvisor.com. Dakota.com. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. If you'd like to catch up on past episodes, check out our website at Dakota.com. Finally, if you like what you're seeing and hearing, please be sure to like, follow, share these episodes. We welcome your feedback as well. Amanda, thank you again for joining us today. Andrew, thank you. And to our audience, thank you for investing your time with Dakota.
Don't say good.